Hello and welcome back to Core Finance. I'm Matt Brown. I'm joined by Brian Noble of TraderNoble.com, and we're going to do a little bit of round the horn, round the markets. What's exciting? Because we were off air and I was just talking about the FTSE's dull. We've done cable around the 130, 133 level. It's getting boring. So excite me. Excite our viewers. What's exciting in the markets at the moment?
I suppose the S&P has just been what the phenomenal move. It's funny. I was over in London 6-7 weeks ago, and I was in with one of the houses, and 85% of their clients were short the S&P when we were trading 2,500. I was back in with them this morning, and here we are, 105 handles higher. Why would you want to be short the S&P? We know that it's going to end, but let's wait till we get the sell extreme. As we said off air, the Swiss National Bank allegedly have $90 billion invested in the US stock market. They own over 3% of Apple, which is just incredible. $10,000 for every man, woman and child in Switzerland is invested in the US stock market. And this is a central bank. So nobody can compete with these central banks. They just, every time the market sells off, they just keep buying and buying. And until we break some key levels, I'm looking at, we've had a double bottom at 25.50 in October. We really need to break below that to get excited on the downside. But then you have big support at 2,500. So it's actually very, very difficult to be short. Plus, we're in seasonally the strong part of the year. Everybody's waiting for Trump's non-event, i.e. the tax reform, which still hasn't been passed. Are we going to get it through? Is it going to be, still more guys rebelling, or is it going to happen? So, until we get this sell extreme, you just keep buying the dip.
And one lesson I think, I've learned, and probably a lot of traders have learned over the years, is don't go against the Swiss National Bank.
No.
We've obviously seen that with the Swissy, with the moves a few years ago. So that's the S&P. What else? What else is kind of on your radar and kind of getting you going and getting the blood flowing?
Well, it was funny when I was coming over on the plane this morning. I was doing a bit of research, and one bit that came across the screen was the Fed's balance sheet. Now, the Fed's balance sheet to go in with QE, when that was increasing, the S&P went, followed it literally tick for tick. Now that they've started to pull back and started to ease the quantitative easing and tighten money supply, suddenly we're seeing the S&P is up here on its own, whereas the Fed's balance sheet is shrinking like this. And if we're to be believed, and they go to correlate back to what we've had for the previous 6 or 7 years, then the S&P could fall 50%. And I think that's why most people are scared to be long this market. They can read the chart, they can read how overvalued this is. The third standard deviation for the S&P is 2792. If you go back to the Nikkei in 1989, when it broke 28,000, it went up to 39,000, which is between the third and fourth standard deviation. And then 10 months later, it was back to 23,000 again. So everybody knows this is going to happen. It's a bit like the euro. When the euro was 160, we all knew it was going to go near parity, which it did. It's how it gets there and the timing is the big thing. So that's one thing I'm on the radar. I'm long but conscious of how much this thing can fall. So you got to have a tight stop behind the scenes. But if the S&P does finally break this 25.50, then you can kind of go short with a stop above whatever high. I know there are wide stops, but when you're dealing at higher prices, you got to allow for that.
And you mentioned the euro. Where do you think the euro is going?
Yeah,
certainly against the dollar.
Funny, when we had the head and shoulders on the euro, all the analysts were out. We're going to 112, 111. Economic data out of Europe has been quite strong. OECD this morning again raised their outlook for next year. Euro then breaks up back up to 119.50 again, and anybody who's short has got slammed. I think with the States, I don't think the States is as strong as we made out for. The Fed are not, they're not stupid. They're easing back the QE, so that's tightening in itself. They can't really hike rates on top of that, or they can really turn this economy over. Rate hikes are not going to happen. That's being predicted. I still think the bond market will rally when we have the next sell-off in the equity market. So it's very difficult to be short bonds, and the bond market is telling you, with the flattening of the yield curve, that we're not far off entering a recession historically. I know that sounds crazy when you've got employment of almost full employment in the States. So I think the dollar will continue to weaken next year. I think the euro, we can back above 122, the year's highs, and then up to 130 is not out of the realms of possibility next year, early next year.
And we've got Powell coming in as the Fed chairman, indicating that the path for the Fed is to increase rates. Do you think they potentially got that wrong if he takes over from the mantle from Yellen?
Well, I think he's just going to be more of the same. You know, he's been on that Fed FOMC himself. He's never gone against the what Yellen has done. I think this is one of the best hospital passes ever when Yellen gets out of here in February. I think she's managed this thing very well. I thought when Bernanke had given it to her, that was going to be very difficult. But she's actually, after a difficult first 6 months when she made a bit of a couple of cock-ups on her initial press conferences, she's just done the status quo. And will they hike rates next month? I don't know. They might do one more, and then I think that'll be it for quite a while.
Now, Brian, you are a trader, and you're a commentator on the markets, but you actually you trade and understand trading. So, this year, good, bad for traders? Do you think?
I mean, this year, if you follow Trader Noble, I'm not trying to promote my own commentary, but if you follow TraderNoble.com for the last year, you would have been surprised how many points you made, which is incredible when you consider the VIX has been sub 10 for probably 35 days, trading days of the year. If you follow my blog without emotion, you make a lot of money, but the key is to follow without emotion, and my updated emails during the day are key. So we've had, actually, apart from September, which is the quietest month that I can remember in years, the last 2 months particularly have been really good. And the summer was good. August was a particularly strong month, but September was really quiet. And I think, volatility, even though the VIX is low, we're having these spikes up to 14, 15, goes back down below 10 again. But I think ultimately we will see a pickup in volatility. I think the States is going to disappoint on the tax reform side. There's so much built in. It's interesting, the DAX can't rally despite the strong economic growth out of Germany. Obviously, we've got the political situation over there where Merkel said there's no chance of forming a government this side of Christmas. This morning in Ireland, the Taoiseach, which is the Deputy Prime Minister, resigned to stop an election there. It's inevitable we're going to get an election in Ireland early in the new year. So I think the political instability is beginning to fester through in Europe, and that should add to the volatility next year, hopefully.
Okay, next year, 2018, the year of volatility. You heard it here first, but in the meantime, Brian, thanks very much for joining us.
Thank you, Matt.